Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The countdown begins. It's CPI day in America. We also get a read on the state of the consumer as Fed Chair Jay Powell doubles down on higher rates for longer. China blasts Biden's tariff move, vowing to take its own action without giving specifics. And OpenAI loses its chief scientist co-founder while Google launches search powered by AI. Happy CPI Day, Manus.
Happy CPI Day. Will it be a rerun of what we had last month? Bonds moved by 18 basis points on the upside. There is this belief that we're moving back into the disinflation narrative. Equities firmly above the 5,200 level. Bank of America's survey saw clients dump $4 billion worth of stock last week. And Mr. Costin over at Goldman Sachs says we are going nowhere through to the end of the year. Multiple expansion, while possible, is less probable. So we're a little bit skittish and nervous going into this. By the way, global equities at the bottom of your screen have had the longest rally since January. So there is this global narrative of easing outside the United States of America. That emboldens that overall narrative. Take a look at GameStop at the bottom of your screen. Again, you are just seeing a little bit of a bid in this meme stock frenzy continue. We'll talk more about what Bill Gross is doing, selling straddles around two of the big names. And Boeing also under pressure this morning. They face a potential criminal prosecution over a deferred prosecution. Bonds are flat at the moment. Euro dollar. I mean, vol in euro dollar. I love this. It's at the highest in 4 months. The hedge funds are covering their shorts in euro. They're not taking any risks going into CPI. Nobody wants to be left quite literally swimming with their shorts down. Danny, good morning.
I think you're so right, Manus, that this market is geared up for a softer print. You look at bonds, yields are down some 25 basis points in the last month. Bank of America showed the biggest flow into bonds since 2022, and you can see why. We've had softer sentiment readings, softer jobs, softer consumer coming from various companies. So what if inflation comes in hot? It is a potentially toxic mix, and one that suggests that the pain trade is yields higher today.
But then this leans into what Powell reaffirmed yesterday. And to a certain extent, the bond market, the equity market have now absorbed that higher for longer. The question is of quantifying that and whether it is a Torsten Slok no cut or whether it is those insurance cuts. But Powell's sounding very steadfast yesterday. So the markets, what are we preparing for? It is CPI day, as Danny just said. It's the potential catalyst to a somewhat snoozy market. That's how it's been described as. Our next guest says this. Central banks easing bias and growth risks are likely to place a ceiling on yields. Let's get to our guest. It is Baylee Wakefield, multi-asset portfolio manager over at Aviva. Baylee, great to have you with us. So it could be a frisky CPI day. It was last month. Bonds ratcheted by 18 basis points. But are we fully absorbed in this higher for longer narrative? You would say that there's a cap on yields in this market. What are you prepared for and what are you hopeful for on the disinflation narrative? Good morning.
Good morning. So, yes, exactly. US CPI, it is the main focus for markets. We have a lot of data coming out this week, but it is the key metric that investors are waiting for. I mean, we can look at this from two perspectives, right? We've got the Fed's perspective. Even though CPI is a focus, it's unlikely to really change the Fed narrative, and that's going to need a few months of evidence to kind of influence that. And as you've said, Powell reaffirmed that yesterday, saying that it's taken longer than previously thought to gain confidence to lower rates. But then from a market's perspective, the mood has been a little bit more optimistic recently, with investors focusing more on the data points like unemployment, non-farm payrolls that show that the economy is slowing in a way that the Fed wants to see, i.e. it's slowing, but it's resilient. So, yeah, even with the producer prices yesterday, investors were really quick to spot that even though the index topped estimates, the components that feed in to the Fed's inflation measures were kind of a bit more mixed. So overall, again, this CPI print is going to be key to see whether we enter another bull market or cause another upset. But at the moment, most investors are waiting on the sidelines to see.
Baylee, it is so remarkable that the difference of 0.1% can do that in this market. We've seen it time and time again, and we've seen this yo-yo back and forth between these different narratives. How difficult is it as we keep flopping from disinflation, maybe inflation is back, is it stagflation? How hard is it right now to hold on to your convictions?
Yeah, it's definitely a market that's kind of difficult to remain invested. But now we believe that there are clearer signals to be overweight equities even. Investors have had multiple concerns to deal with so far this year, even, branching into areas like geopolitics, the speed and direction of interest rates, and whether growth projections were on the more optimistic side. But from the Fed's point of view, it seems that their focus is trying to somewhat reduce that uncertainty and give confidence that even though higher rates have been kind of slower to take effect, their stance is the same and it's going to pay off eventually.
So, Baylee, look, the bond markets have been leaning into the softer economic surprises here in the US, whether it's the jobs, the average hourly earnings. So there's a little bit more of a lean in there. As Danny set the table at the start of the show, down 25 basis points in the month of May in US Treasuries. But I'm looking at the UK, and again, there is very much the UK and the ECB. This divergence has been a very heavy narrative in the market that the Bank of England and the ECB would outgun the Fed. Are you still in that camp? I know that you've got a conviction on gilts. Hugh Pill said yesterday, of course, the Bank of England had capped underlying price pressures. Do you think we get more divergence or convergence is the new narrative for the back 6 months?
You know, there is some potential for some divergence there. We do have our long UK gilts position at the 10-year point. The Bank of England has opened the door to a June rate cut after pointing to demand growth potentially remaining weaker than supply and key indicators of inflation pressures, although they're still elevated, they are moderating broadly. And while growth has improved, data has been broadly, fairly poor. As you've said, we've seen economists saying that there's still a lot of work to do to curb price pressures, but it's not unreasonable to expect cuts being considered over the summer.
Baylee, can I get back to your equity call? You said just a moment ago that there are clear signs to be overweight equities. But if you look at what equities are doing now, in a whisker of an all-time new high, but what's got us there is utility stocks. Over the past month, utility as a sector has gained 12% versus the S&P's 3.5%. That's not the index you think would be doing well on risk on. That's the safety. That's the bond proxy. So what does that tell you if that's how we got to the point we're at right now?
Yeah, sure. I mean, I take it as a positive for markets that we aren't just seeing a rally in the Magnificent Seven. We are seeing a broadening of earnings expectations beating, sectors that have been previously under-owned and potentially somewhat undervalued being bought up by market participants. So overall, that broadness of the market rally is something that's quite positive for equities.
And then I look at European stocks as well this morning, and they're at another record high. You've increased your exposure to the European complex. I'm just looking over the past month, just as Danny said that. And again, in Europe, it is utilities which are up 9% relative. She's a good one. She comes in, actually, she's in 10 minutes before me, so she's the early bird that catches the worm. But again, in Europe, it's utilities up 9% relative to the stock 600, up 3.4%. How are you exposed in Europe? And again, to Danny's point, that is a more of a bond proxy in Europe relative to risk on.
Yeah, so as you've said, our conviction has increased in European equities. Europe is at more of a cyclical low point. Earnings revisions are becoming more positive after being a beneficiary of low earnings expectations, and valuations are attractive. It's one of the only regions that PEs are still below kind of the 10-year averages. Most sectors, as we've just been talking about, they look cheaper in Europe versus the US. So it's more than that, just that Magnificent Seven story. And investors have been underweight versus the US as investors have been chasing that US exceptionalism. And since the GFC, there haven't been too many compelling reasons to buy European equities relative. And, in addition, we're seeing buybacks increase in Europe. So buyback yields are essentially in line with the US. But then, above all, we've got the ECB. They've provided that tailwind to the equity story by providing more certainty that they will be cutting in June.
And just to be fair on that, I mean, it's banks, media and industrials that overall year to date have outperformed. But I think it's interesting, Danny's point, in terms of the near-term highs have been taken out by utilities. Yeah,
and Manus, as I say that, of course, utilities, the safe things leading us there, but also meme stocks. So I don't know, get your head around that. Baylee, I'm afraid that's all we have time for. You're going to escape our meme stock question this morning. Baylee Wakefield of Aviva Investors. All right, Manus, let's get to some of the other top stories that are trending on the terminal this morning. The U.S. Justice Department has found that Boeing is in violation of a settlement. That settlement had allowed the company to avoid criminal prosecution after 2 deadly crashes more than 5 years ago. It's now up to the DOJ to decide whether or not to file charges against Boeing. In a statement, the U.S. plane maker said it believed it had honored the terms of the agreement.
China is said to be considering buying unsold homes to support its troubled property market. According to Bloomberg sources, the country's State Council is currently seeking feedback on the plan. Now, it would involve state-owned enterprises buying the homes at steep discounts, using loans from state banks and turning them into affordable housing.
A group of U.S. TikTok creators have filed their own lawsuit to block the law that forces ByteDance to sell the popular video app or face a ban. The group includes a Texas rancher, a seller of skincare products, and a book lover who promotes Black authors. Their lawyer says the creators see the U.S. law as an attack on the free speech of the roughly 170 million Americans who use TikTok.
I'm one of them. Coming up, Beijing blasts Washington after a sweeping new set of tariffs on Chinese goods. More on the story. Context matters on Bloomberg.
I want fair competition with China, not conflict. When you make tactics like these, you're not competing. It's not competition, it's cheating. And we've seen damage here in America.
Have been long awaited, but it happened. President Biden signing fresh tariffs on Chinese goods into law, and Beijing has fired back, writing in a statement, quote, China will take resolute measures to safeguard its own rights and interests. The U.S. should immediately correct its wrong actions and cancel the additional tariff measures against China. For more, let's go over to Bloomberg's Bobby Ghosh, who's at the Qatar Economic Forum, having many discussions about geopolitics there, I am sure. Bobby, great to see you this morning. Okay, so China says we will do something unless you remove these tariffs. What could that something possibly be, Bobby?
Well, as you say, there's been a lot of speculation about that at the Economic Forum, and I've been speaking to people about it, and there's a little bit of surprise that China chose to respond with rhetoric rather than direct action. As everyone says, we saw these tariff increases coming, perhaps not quite to this extent, but there was every indication that they were coming, and surely the Chinese had a package of retaliatory tariffs sort of locked and loaded and ready to go. But they've chosen to respond with rhetoric, and that perhaps says something. I think the Chinese economy at the moment not in the strongest state, as you pointed out in the introduction just before we came to this segment. This is a country that is thinking of having regional governments buy out empty housing in order to deal with a really serious real estate problem. So Xi Jinping's hand not as strong as it might have been a few years ago. The expectation is that they will retaliate with some perhaps restrictions on exports. It's unlikely that they will want to do a great deal of damage to American companies. China desperately needs foreign investment at this moment. It could use American companies and American investors investing in the Chinese economy. And so if Xi Jinping's hands are not entirely tied, then they're certainly not as free as they could be. We'll see over the next couple of days what exactly the response is. But the suspicion here and among analysts who watch China closely is that it probably won't be a full spectrum response that we might have seen a few years ago when China's hand was much stronger.
Bobby, we want to get a sense from you. Obviously, you're in the Middle East. They're dealing with their own hot conflict in terms of how to handle that. But in terms of another conflict, Ukraine, Russia-Ukraine, we've got Xi traveling to China. What do you think he wants an expression from Xi? You talk about that no limits friendship. Will he get a reaffirmation of that? What's the purpose of the trip?
Well, the purpose of the trip, Putin has just won re-election. This feels very much like a supplicant going to the emperor in China and sort of looking for a reassurance of that forever friendship, looking for a reassurance that Chinese trade to Russia will continue. Remember, China is under a lot of pressure from the West to reduce that trade. Putin needs Chinese trade to keep his economy going. He needs Chinese materials to keep his military strength growing, and he will want reassurances from China. the Chinese will want some explanation from Putin, I would imagine, about why he has decided in the middle of this conflict to change his defense minister, not just change the defense minister, but to replace him with a technocrat, with an economist, somebody who doesn't really have that much military experience. The Chinese will want to know what's going on there.
Doesn't this run counter, though, to what Xi was just doing in France, what he was just doing in Europe, trying to court the Europeans, saying, hey, we can be a partner, not just the U.S., and Europe's response in large part was, well, you support Russia's war machine. Doesn't this undo a lot of what he was hoping to accomplish by a European trip?
I think that is part of the reason why he wasn't able to accomplish a great deal in Europe. The Europeans pressed him over and over again exactly on this point. How can you say you will be our friends if you are helping a country that clearly is no friend of ours, and a president in Putin whose ambitions are obviously not restricted to Ukraine alone. And so, yes, this does underscore the point. The message that the Europeans will get is that the friendship between China and Russia remains very, very close, and therefore Europe needs to hold China at an arm's length.
Bobby, very briefly, you are there in Qatar, which is the hub point for negotiations for an off-ramp between Hamas and Israel. What is the discussion there about coalition forces from the likes of the UAE, from other Arab nations, being part of some kind of coalition force post this conflict?
Well, I literally just came out from a conversation that John Micklethwaite, our boss, is having with General Petraeus, the former director of the CIA, former military commander, and he made the point that there's going to be no appetite from any of the Arab states to send in forces to be peacekeepers in Gaza when there's no guarantee that there will be a political way for the Palestinians to achieve independence, to achieve statehood, unless Israel is willing to make firm commitments, and the United States is willing to back and guarantee those commitments, that there is a path to a two-state solution. It's unlikely that any of the Arab states, whether the Egyptians or the Moroccans or the UAE, will agree to send their troops, because then they'll just be seen as, oh, we're just cleaning up the mess that Israel made, and no Arab state wants to do that.
Nope, they certainly don't. The bar is going to be very high to get any kind of buy-in on that. Bobby, thank you very much. Great reporting from the Qatar Economic Forum.
Indeed.
More to come from there. Now, breaking news on TikTok. Frank McCourt is set to buy and rebuild TikTok. Now, this is according to Semaphore. Danny, who is Frank McCourt? That's what we first sort of looked at one another and said, well, of course, he is yet another billionaire. He's the executive chairman of a family real estate giant and tech innovation initiative company Project Liberty. So what was it you said to me? You know, what better solution than to have another billionaire?
Well, two things. He plans to buy it. Is TikTok going to actually sell? That's very questionable. Yeah. They're going to sue the U.S. until, time ends itself. But I love it. He told Semaphore he wants a new and better version of the internet where individuals are respected and they own and they control their own identity and their data. Has the man ever been on the internet before?
There's something called VPN. It tries to protect your identity when you're out there. But of course, Mnuchin, we know he's hustling. He's hustling people as well in terms of his desire to get his hands on TikTok. We can talk about this forever, but we've got meme stocks to talk to you about. So we're going to take a quick moment and reprieve, and we'll be back with a little bit more on meme stocks. It's Bloomberg Brief with Manish Krenny and Danny Berger in New York. Time for a quick look at what's on the front pages and making news headlines around the world. First up, we have the Financial Times. Vanguard appoints Salim Ramji as the new CEO. Ramji led BlackRock's iShares and the ETF business. Yeah, that's a bit of a monster business. Replaces Tim Buckley, who's planning to retire after 6 years as the CEO.
And this is very weird for Vanguard. They usually just promote people internally, so this is definitely a shift for them to go outside. Now,
Shaker.
Next up on the Journal. So this one really caught my eye. Front page of the Journal. But Walmart, the biggest retailer in the U.S. by revenue, they show that Amazon is likely to overtake them. Our own Dan Curtis also did some number crunching. Based on absolute sales, they will overtake Walmart by 2026. We're going to get Walmart earnings tomorrow. And I just wonder how much of this, who's the biggest retailer, will be who can navigate the slowdown better? Who can navigate lower-end consumers wanting to trade down, wanting cheaper goods? Is it Amazon or is it Walmart?
Yeah, well, I mean, at this moment in time, Walmart makes over $1 million a minute. And if you just think of actually what Walmart's house is versus Amazon, Amazon has cloud, it's got the whole sort of infrastructure around that, which in theory, should be the alpha of growth. Finally, and this got us both looking, the bond king, he normally talks about where 10-year yields will be, but Bill Gross, I mean, he's diving into this meme stock frenzy with gusto. The dude is selling $40 straddles, in other words, selling calls and puts. He doesn't think we're going to move much out of the bandwidth of where we are at the moment. But if you want to understand vol, I mean, this is what you call a man hungry for vol. This is the equivalent of 400% annualized volatility on these straddles.
What happened to the bond king? So far from the land of bonds. This is the world we're in, where Bill Gross is selling option straddles. But look, you have all these institutional people, like Boaz Weinstein was complaining yesterday that the market's gone haywire. I'm sorry, stop complaining and do a Bill Gross. Make money off of it.
Most people involved in institutions who are sitting on desks, who I know, are quite happily trading Bitcoin, meme stocks. The truth be told, wonder if they all told compliance.
You hope so.
It's over the counter. Most of it's over the counter, so they're grand.
I was going to say maybe the calculus is they make so much money. If compliance finds out by that point, it doesn't matter.
Death, taxation, and compliance. You heard it here first.
All right, coming up, we're going to speak with none other than Paul Donovan. From our global headquarters in New York, I'm Danny Berger alongside Manish Cranny. Let's set your agenda.
It is CPI day in the USA. We also get a read on the state of the consumer as Fed Chair Jay Powell doubles down on higher rates for longer. China blasts Biden's tariffs move, vowing to take its own action without giving specifics. And OpenAI loses its chief scientist, co-founder, while Google launches search powered by AI. The world is on the move. Danny.
Well, 3.5 hours until we get you your CPI report, followed by retail sales. We're going to talk to Mike McKee on what to expect in just a minute. Until then, little movement in S&P futures. They are slightly higher. We are 0.2% away from an all-time record in U.S. stocks. We hit a new record on the NASDAQ yesterday and global equities. Dollar, that has been softer. Again, this has been the lead up into CPI so far this month. Dollar softer and yields lower. We're lower by another, let's call it 2 basis points this morning, 4.4%. And Manis, again, we've come down about 25 basis points, but year to date, we're up by some 60 basis points. Half of this move, this is by Liz McCormick and team, who've done a great job on the data. Half of the move of the 60 basis points we've gotten higher this year has come on CPI day. That is what's at stake, especially in a market that started to trade like inflation will be softer.
Yeah, and to a certain extent, we saw this jolt in the last CPI day that we had, where it was jarring for the market. Bonds ratcheted by 18 basis points. It certainly was a jolt. We've also had other indicators, sort of mini curtain raisers from the New York Fed, along with Michigan. The New York Fed just the other day, it was the short-term and the slightly longer-term inflation expectations. Of course, our next guest is a little bit scathing in terms of using those as precursors for what could come.
Well, definitely the concern is if you have consumer sentiment that's really bad. Let's say retail sales comes in weak. You have some of these companies talking about the consumer not doing as strong. We saw a flex of that in Home Depot, and inflation is still high. Manis, are we going to start talking about stagflation again? That seems to be the worry, that if you get all the readings moving in the right direction, except for inflation, perhaps that needs to be reintroduced.
Well, it's certainly one of those left tail risks, along with no cuts at all. So the Fed Chair, Jay Powell, he spoke yesterday. He doubled down on the central bank's needs to wait for more evidence that, you got it, inflation is cooling.
The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
Classic plead. A little bit more patience, please. Mike McKee is with us. Mike, talk us through CPI and what that means, breaking it down. We're looking for a little bit of disinflation. Where's it going to come from?
Well, that's the question the Fed would like to know. They're hoping that we see it in housing. in this report, because housing has been the Godot of disinflationary indicators. It just doesn't show up, even though they're expecting it to. However, overall, there's a general feeling, and economists are backing this up in our Bloomberg survey, that we are going to at least see on a year-over-year basis inflation start to go down again, 3.4% for the headline, 3.6% for the core. And economists are generally pretty good at predicting the price indexes, so we probably won't have much of a surprise there. The surprise could come in retail sales, because that one is very heavily revised, and it depends on response rates, and holidays affected. So we could see a surprise there. The forecast is for just a 0.1% gain, so the surprise might be to the upside.
The surprise might be to the upside. I mean, what kind of mix is that? If inflation, let's say it comes in as estimated 0.3% for the core, but you do see an upside surprise in retail, are we back to talking about no cuts again, maybe even a hike?
Well, that's funny because of what Jay Powell said about patience. He's talking to the bond market. You guys out there, he's talking, have patience. Everybody's going to be looking at the core rate today to see if that's what's really influencing things. If the core keeps going down and the PCE core keeps going down, then the Fed can look to cut rates. And if we see a little weakness in the economy, that just helps make the case. But if the economy is strong, that kind of pushes it out some.
Where are we on the soft data to the hard data? Because you look at some of the soft data, the economic surprises is certainly dipping. And in a relative sense, that's where the market is, bad news is good news. I mean, we're in that classic kind of situation. Every time we get a little bit of a dip on some of the softer indicators, there's more hope for these rate cuts to come, isn't there?
Yeah, and we've seen dips in the soft indicators. The ISM numbers, both manufacturing and services, have gone down a bit. The consumer confidence numbers have gone down a bit. The consumer confidence from the University of Michigan in terms of inflation has gone up, which is not particularly good news. But the hard data keeps coming in at a relatively strong pace, and we're still seeing the Atlanta Fed GDP now forecasting close to 4% growth. I mean, that will come down. We don't have a lot of data in that yet, but it shows that people are kind of getting used to the idea that it's going to take a while for all this to turn around. You had Jay Powell talking about patience. Everybody on Wall Street is going to trade on these numbers this morning. It's going to be a big deal. Jeff Schmidt, who's the new Kansas City Fed Bank president, last night said this is going to require a data-dependent approach that looks at data over time rather than loading too much weight onto any one release. Well, anybody want to bet the trading desks are going to have a different view on that?
That was prophetic, wasn't it?
No, but I just love that. It's like we're data dependent, but like not this one piece of data. We're data dependent, but on,
It's called cherry picking.
Or leaving yourself optionality, perhaps.
That's the way they... Optionality is good.
Yeah. Mike, thank you so much. We'll see you again in less than 3 hours to break the data. Mike McKee. All right, our next guest, Paul Donovan of UBS, writes that the Federal Reserve Chair Powell's unnecessary elevation of the role of the Consumer Price Index has probably delayed U.S. rate cuts. Joining us now is Paul, who is a Global Chief Economist at UBS. Paul, why are they over-concentrating on CPI? What's the issue there, and what should they be paying attention to?
Well, so the issue with CPI is that a quarter of the calculation is a fantasy. Owner's equivalent rent, a price nobody actually pays. So this is why the consumer in the States has been doing better than expected, because the consumer has got a higher real wage growth. If you own your own home, your inflation rate in the States is far closer to 2% than, it's 3% plus, because a quarter of CPI is a fantasy. This is why traditionally the Fed has never really focused on CPI. But back in the policy eras of June 22, Powell starts talking about CPI, starts talking about CPI expectations, and that's why we're in the mess we're in today.
Paul, good morning to you. So if that is a fantasy, to quote you, in terms of nobody really pays that level of rent, again, I would ask you as an economist, what do you make of some of the fissures in the data? We can cherry pick which one you want. You can go for a bit of hard data on non-farm payrolls, average hourly earnings, or you can have, which Danny and I have leaned into, which is the consumer sentiment. You've got ISM services. You have a number of indicators, and I'm not an economist, but these are beginning to show moderation, and perhaps the back 6 months there will be a disinflation narrative and a more material slowdown in the consumer than we currently presume.
So if you look in the detail of the inflation data, market-based prices that are set by supply and demand in the global marketplace, they're already very weak. They've been coming down a lot. If you look at durable goods prices, they've been in deflation, falling prices for months and months and months now. So all of that is coming down, and that's reflecting the fact that the economy is slowing. And of course, it's slowing. You've got the highest interest rates in 23 years. You've got fiscal tightening going on. There's a fiscal drag in the US economy. Of course, the economy is slowing down. When it comes to looking at the broader data picture, at this stage in particular, I would really caution against anything that is a sentiment opinion poll. These have been becoming steadily less reliable in recent years. And they're now just reflecting the enormous political polarization that exists in the United States. You ask a Republican how things are, they say it's terrible, worst it's ever been. Ask a Democrat, oh, it's far better than whenever Trump was in charge. You're not getting a clean picture from sentiment in the States anymore.
So, Paul, if you can't look at the sentiment, how much attention then do you pay to individual companies? Do you pay attention to McDonald's, to Starbucks, to even Amazon, who are saying that the consumer isn't willing to pay as much? How much importance do you put on those companies?
So I do put importance on corporate statements. You've got to remember, the large listed companies are a minority of economic activity in the States. It's the mom and pop stores that still dominate. But that doesn't mean we ignore the large listed companies. And I think that they are right, that we've had this episode of profit-led inflation, particularly in consumer retail for goods. Food and goods. And so what has happened now is consumers are rebelling against that and saying, you know what, we're not going to be ripped off anymore. We're not going to pay that inflated price. And so there is pushback, and that is being reflected by the corporates. What we do have to reflect on, though, is that there's also more spending on having fun these days. Yeah, and, no disrespect to Walmart, perhaps a weekend trip to Walmart is not that much fun. So with that shift, other companies need to have a higher focus, perhaps.
Well, hang on, but you got to buy, like, milk and groceries. You can't just not eat and go have fun. I don't think that's
Paul's not going to be welcome at the doors. The Waltons aren't going to be throwing their arms around you, Boyle, when you come to Walmart on your next trip. Danny just put in the IB, so is hedonism of the consumer, the United States, US consumer debt, which takes us to a very important point. Household debt, $17.7 trillion. We're looking at household debt and delinquencies. And I'm specifically looking at some of the equity loans. They're ticking up, the highest since 2008. But when I look at delinquencies, Paul, nearly 7% on credit card are in serious delinquency, up from 4.6% a year ago. And the young ones, 18 to 29 years, are delinquent at 10%. Are these confirmations of real concern about the hedonism of the consumer in the US?
I would say they're not necessarily a problem for the hedonism of the consumer, because it's middle-income consumers that are driving the economy, and they're doing generally okay. What I'm saying is that this is a reflection of Powell with his casual, oh, higher for longer, it doesn't matter, we need to be restrictive. What he is doing is creating social division. Because what you have here is lower income, younger generation consumers who are feeling the pain of higher for longer. Middle income consumers are not feeling that pain. Their inflation rate, if you're middle income, your inflation rate's a lot lower because you own your own home, you're not renting, so you've got a far lower inflation rate. And so that disparity in real disposable income and in the cost of credit and who it's affecting, that's where the problem comes in. And that, I think, is why we're seeing these delinquency levels rise in what is quite a significant way, but it's confined more to the lower income and the younger generation.
Right, well, it's the illusion of the aggregate, Paul. On an aggregate, the U.S. economy is doing well. On an aggregate level, the consumer is spending and is doing okay. It's the stress in the margins. Paul, at what point does stress in the margins become a problem for the aggregate?
The reality is that unless the middle income group, which is roughly the 30 to the 80 percentile of income distribution, unless they're really feeling the pain, it's not going to affect the aggregate. The lower income group, the bottom 30%, obviously matter very much from a humanitarian, from a social point of view, but they don't have the spending firepower to make much of a difference to the aggregate. And the top 20% do have a lot of spending firepower, but their consumption is generally fairly stable. They don't have the volatility. That's why you focus in on the middle income group. And the middle income group has higher real wage growth than is commonly supposed because they've got a lower inflation rate. They've still got some savings from the pandemic era. They've been able to cut back on their monthly savings rate, which has enhanced things. They're still spending money on having fun. Somebody's got to buy the Beyonce concert tickets.
You're absolutely right.
Is it Paul Donovan? Paul, did you go to Paris to see Beyonce?
I did not manage to get to Paris to see Beyonce, unfortunately. I'm more of a Swiftie anyway.
Oh, well, we can track
that's
them.
what
We
I
can
meant
track them
anyway.
where you went to buy
your
your Taylor Swift tickets. You can come back and tell us that another time because we know where you're not going, and that's Walmart on your next trip to the United States of America. Paul, great to get you with us. And as you say, a bifurcation in the hedonism of the U.S. consumer. It's a subplot. Paul Donovan at UBS. It continues. Coming up, Burberry warns of the challenging times ahead as their sales drop due to weak demand. You got it. We discuss Context Matters on Bloomberg. Good morning. Bloomberg Brief with me, Menace Cranny, and Danny Berger alongside me in New York. So stocks in Burberry is hitting the skids this morning. The luxury retailer has reported sales tumbled. This was as a result of weak demand in China and here in the United States of America. Deborah Aiken is with us for Bloomberg Intelligence. I mean, Deborah, if we look at these numbers, Burberry seemed in line. So can you run me through why... what is it that shocked us about these numbers? Why is the market a little bit hesitant this morning?
Hi, I think it's, we already in January had a profit warning and a guidance for this Q4. The 4Q was up against a particularly difficult base. They grew 16% last year in their 4Q. So it's about flat numbers in the 4Q, but it's about minus 12%, flat numbers in the full year, but minus 12% in the 4Q. And that in particular was across all regions. There's heavy decline in China, minus 19%. And then also it's on the upline, the expectation that actually we're not seeing demand come through. The order books aren't as high as they could be. So it's going to be about spending more and that profit line, in particular EPS and operating margin, being under pressure into 2025.
Deborah, it's a big day to get a sense of how consumers are doing. We get retail sales in the U.S. today, but what we've seen time and time again is with these aspirational type brands, consumers aren't as willing to buy or they're not buying as much. So if you are a brand like Burberry and you're also looking at Gucci struggling, Kate Spade struggling, is there a clear path to getting back on track?
So it's a difficult stage at the moment. I think under CEO Jonathan Ackroyd and what he's done and what he plans to do, they've come in with a big runway collection and that's higher price. So that's difficult in a really soft market, but it's something that was planned pre the market. So that bites them, but they are coming through with new product. They have 50% of product now from the new designer, Daniel Lee. They head into their third collection and that's generally in a normal market where things would temper out. They're coming in with some core product at lower price. They're doing more in bags and more in ready to wear where they're still very soft. And then they're going to focus their probably raised marketing spend more into China and the US markets to really redefine and elevate the brand.
Okay, Deborah, thank you very much. That is Deborah Aiken of Bloomberg Intelligence. Let's turn to tech now. And OpenAI's chief scientist, Ilya Sutskever, is leaving the company. He is one of the several board members who moved last November to fire the CEO, Sam Altman. Let's get over to Bloomberg's Tom McKenzie on this. I mean, Tom, here you have a man that I think many people expected to leave sooner because he was part of that whole uproar of trying to get Sam Altman out. So why now? Why is Sutskever finally leaving?
Yeah, indeed. And according to reports, he actually hasn't been in the office since November, when, of course, all of this transpired. And Sam Altman was temporarily, at least for 5 days, no longer at the head of OpenAI. And Ilya Sutskever was key to that. Of course, he had a seat on the board and he voted along with 3 others to oust Sam. And then he came out and said he regretted it after about 770 employees of OpenAI threatened to quit in light of that. So he'd taken a back seat, to say the very least, since those events, and he stepped down from the board, but it continued to have an official role. Now he's come out and said that he is now stepping down. He's going to be pursuing other projects. This was he is a deeply respected researcher who had been appointed back in 2015 by Elon Musk, by the way, who was one of the original investors in OpenAI. So look, he says the progress that's been made at OpenAI has been miraculous and key as well. Within his statement, he says he does think it's going to be safe and deliver real benefits, because safety is key. That's where the clash came about between Ilya Sutskever and Sam Altman. He wasn't convinced that Sam was pursuing this in a safe way. It seems now he is. He's ready to take a step back. He's going to pursue other projects. And he thinks, according to at least his statement, that OpenAI is on the right track when it comes to the safety.
Well, if we look at Google, I mean, it's a real one CEO who's taken a step forward and really sort of putting his money where his mouth is Sundar Pichai. We've got the Google Developer Conference. That was yesterday. What have they announced? What are we going to do apart from Googling? What's going to be the new word? I tried to use AI this morning. I tried to use ChatGPT this morning.
For what?
I'm not going to tell you what I tried to use.
Oh, my gosh.
I'll tell you what it was. I was actually searching for Alan Greenspan's speech in 2000 where he talked about productivity rising by 3.5%. You see the thing she asked?
It's kind of ironic. I feel like, your productivity is rising by just using ChatGPT. I like it.
Hey, look, the good news for Manus is when he searches for those Gucci slippers, he's going to get a little summary now.
I'm more Hermes than I am Gucci. Gucci's very 2015, Tom.
I'm prodding you, Manus. So what they're going to do is they're going to layer in. They've got the Gemini model that they're going to layer in with that Google search, and on some searches for your Hermes slippers, they're going to come with a little summary to show you where to go in New York to find the closest slippers and the best line in terms of the particular size and fit and comfort and cost, all that kind of stuff. They're going to do that every now and then in terms of some of the searches. They're going to be layering in the model, the Gemini model, with the search. The big question is, they get about 175 billion in terms of revenues from the search. Does it squeeze margins because there's more compute involved in creating these summaries? And does it cannibalise some of the advertising business as well? Because you don't have to click through as many links. So that's a big question. They've always had the research around AI, Google. The question has been, can they actually implement that and commercialise it? And that's where the challenge is. And they've hoped to make some big progress with the Developers Conference and some of the announcements that have come through, one of those being the upgrades around search. Because, of course, they do face that competition from OpenAI, amongst others with the chatbot and the likes of Cohere as well. And they hope that they're now meeting the challenge.
Well, let's just have a little test here, Tom, shall we? Hermes slippers, New York, best shop.
Oh, gosh. He's actually going to buy them now, Tom. You've created a monster.
No, it comes up with... No, it comes up. You see, it doesn't know my accent yet. That's part of the problem here. We got to go. I'll let you know where the value in the Hermes slippers are, Tom, when you're back with us. That's Tom McKenzie on All Things Tech. We're losing the plot this morning. Coming up, we're going to set you trading diary for you. Context matters every day on Bloomberg.
This is Bloomberg Brief. Danny Berger and Manus Cranny in New York. Now, while Manus asked ChatGPT for Hermes slippers, let me get you set up for the day ahead. So it's a big day. We have CPI and retail sales. Both of those will come out at 8:30 a.m. Eastern. Then Minneapolis Fed President Neil Kashkari will be speaking at 12 p.m. And then Cisco reports its third quarter results after the bell. Manus, any luck?
No, none. But it is picking up literally every part of the conversation that we have. Some micro movers for you. Keep an eye on these. Boeing faces possible criminal prosecution after the Justice Department, Danny, found that they violated a deferred prosecution agreement tied to 2 fatal crashes. The stock down over 1%. And we've got meme stock anonymous. There we go. We're roaring ahead. GameStop and AMC both flying high. And of course, we covered this morning, didn't we? Bill Gross, he's not having any of it. He sold straddles around this.
Yeah, I love it. The market's more calm, but, meme stocks still alive and thriving.